analysis report lays out a strong bullish case for RCAT Holdings, and it really boils down to this. Q3 2025 revenue is up 646%, all driven by major U.S. Army contracts for their Black Widow drone.
That is, an absolutely massive number. 646%. It's impossible to ignore. It certainly proves the company's entire operational scale has changed.
It really has. And that huge shift actually brings us right to our first piece of feedback. It's all about aligning the tone of the analysis with, the credibility of the financial content itself.
Right.
The initial framing, specifically the title and hook that are just hammering that 646% spike, it risks undermining the analysis's long-term credibility by leaning just a little too heavily into sensationalism.
This is a tension point we see all the time. The data itself, that 646%, is verified. It's amazing. But when you wrap that data in a title like, 646% revenue growth, exploding head emoji.
Yeah, with the exploding head emoji.
Exactly. It just immediately signals, let's say, a kind of amateur enthusiasm, not institutional rigor, which is a shame because the actual analysis is quite rigorous.
It's such a fine line, isn't it? Because on one hand, you want that viral punch. You need to grab attention.
Of course.
But on the other hand, what you're analyzing are multi-million-dollar long-term military contracts. That's serious business, and it demands complete confidence in the analysis.
Precisely. If I'm a sophisticated investment decision maker and I see that emoji, my first reaction is skepticism. Just for a second, even if the underlying numbers are rock solid. The weakness is that the report structure relies too much on this spike chart idea, this anomaly, instead of framing it as proof of a fundamental, strategic shift.
So the suggestion here is to recalibrate the introduction, the whole tone, really. The emphasis needs to move away from the sheer magnitude of the percentage and focus more on the significance of it.
Yes. The point isn't just wow, big number. The point is that RCAT is successfully gone from R&D, from the concept phase, into mass production and deployment. That's the real story.
Okay, that's a huge structural difference. So how do you actually execute that? 646% is still your most compelling data point. You can't just bury it.
You don't bury it. You contextualize it. Instead of using it as the headline, you use the strategic contract status as the anchor. So the analysis should frame that $9.65 million in Q3 revenue not just as a big number, but as the moment of confirmation.
Confirmation of what?
Confirmation of the entire relationship with the U.S. Army Short-Range Reconnaissance Program, the SRR program. It proves the concept is viable and the relationship is real.
So the growth becomes the evidence of the strategic shift. It's not the entire story itself.
You got it. So for a title, as a concrete example, you might focus on the program of record status, which means reliable multi-year funding. Anchor the analysis in that, or the $35 million contract expansion. Then the 646% figure becomes the undeniable proof of successful execution on that commitment.
I like that. It gives the whole piece a much stronger, more mature foundation. It moves from, look what happened last quarter, to here's the long-term program and here's the Q3 data that proves they can handle it.
And for this sector, for defense spending, that's everything. Investors want stability. They want certainty. A shock spike can almost suggest volatility.
Right.
But focusing on the program of record status, that suggests budgetary certainty. And that is a much, much more powerful bull case for any serious investor.
Okay, let's move to our second area, which gets into risk assessment. The report does a really good job laying out the risks. But to make it more robust, the discussion on profitability and execution risk needs to be explicitly quantified against the company's huge cash position.
This is about connecting the dots, really. The risks section, it correctly identifies the main threats. You have the minus $16 million Q3 net loss, and then this enormous operational challenge of scaling up to manufacture 1,000 drones a month. The report calls it execution risk, which is accurate.
But then the analysis keeps the $212.5 million cash and receivables war chest completely separate? It's sort of over here in a different section.
It's in a silo. It's presented as this nice-to-have safety net, but it doesn't actually interact with the risks that were just laid out.
And that separation is the weakness. It limits the analysis of the company's financial runway. We don't get a sense of how much of a cushion they actually have to absorb setbacks.
Right. The cash pile is treated as a passive asset, not an active risk mitigation tool. So the core suggestion is simple. Directly link that cash to solving those primary risks.
Okay, so you'd want the analysis to articulate, say, how many quarters of loss that $212.5 million could cover at the current burn rate. Give us a number.
That would be a great start, a clear, quantitative runway. But to make it even more powerful, the analysis should specify how that cash is being actively deployed to mitigate the scaling challenges. How much is being allocated to expand factory capacity to hit that 1,000 unit a month goal?
So we're moving beyond just saying they have cash and into analyzing the actual utility of that capital against the $16 million quarterly burn and the scaling problem.
Exactly. I think the report says something like, they have the cash to build factories and fill orders now. That's a good start, but it needs analytical development. You have to prove it.
So what would that look like in practice? A concrete example?
You demonstrate that the cash serves two functions. First, preventing shareholder dilution, always a major concern. And second, that it's a strategic asset specifically dedicated to solving those profitability and execution hurdles.
Could you use that to address the risk of government funding delays? The report mentions things like continuing resolutions, right? Those short-term funding gaps that can slow everything down.
Oh, absolutely. That's a perfect example. The analysis should explicitly show that the $212.5 million is enough to cover the internal CapEx for scaling production, yes, but also that it's enough to weather those external macro risks, like budget delays from a continuing resolution.
That's a fantastic detail, because it shows the company can keep its aggressive 2026 production ramp on target, even if its main customer, the Army, hits a temporary bureaucratic wall.
It completely reframes the risk. It says these risks aren't existential. They are manageable because the company has quantified them and dedicated resources to them. It proves they can afford to execute, even with delays.
Okay, let's go to our third and final critique. This one focuses on the future revenue projections and their competitive advantage. The analysis needs to clarify the competitive moat by really digging into the significance of the Black Widow being part of a broader family of systems. That's what will really solidify that forward-looking projection of over $100 million.
Yeah, the groundwork here is excellent. The report identifies the product, Black Widow, and the driver, the SRR program of record, but to justify revenue nearly tripling to over $100 million in FY 2026, you need more. The current contract expansion alone, it might not be enough to justify that scale.
So the weakness is that this crucial detail, the family of systems, which includes the Teal 2 and the FANG FPV, it's mentioned, but it's not really functionally integrated into the forecast. It just reads like a list of other products they make.
It feels like an appendix item, not a core strategic advantage. So, to really secure that long-term forecast, our suggestion is to strengthen the forward-looking argument. Explain how the family of systems provides real integration benefits or future contract leverage.
We need to show how the success of the Black Widow creates other opportunities, like cross-selling, within the military.
Exactly. Think about it. The military is moving toward connected, platform-based warfare. If the Army is adopting the Black Widow at scale, it's not just a product success. It means they're successfully integrating it into their command and control architecture.
And once you're integrated,
that creates enormous inertia. It makes it so much easier to get them to adopt other compatible systems from the same supplier. Systems like Teal 2 or FANG FPV.
so the moat isn't just, we have a better drone. The moat is, we are already baked into the system.
That is the whole ballgame in the defense sector. A product advantage can be challenged by the next competitor. A platform advantage, one that's rooted in integration and interoperability, the switching costs are astronomical. It's incredibly resilient.
Okay, that makes the $100 million number feel much more defensible. So how can we make that explicit in the report?
You need specific analysis showing how this suite of products secures RCAT as a long-term supplier for different facets of reconnaissance, not just this one SRR contract.
For example, you could show that because the Black Widow works so well within the Army system, it dramatically increases the odds of, say, the Navy or the Marines adopting the Teal 2 for a different need.
That's the key. You have to explicitly leverage the SRR program's success to show that it de-risks the adoption of their other products. That gives you a really robust, logical basis for why revenue could triple. You're shifting the argument from they have a big contract to they are an integrated, indispensable partner in the U.S. military's drone ecosystem.
It transforms the bull case from one based on today's delivery volume to one based on future systemic dependency. It makes it clear why a procurement office would keep coming back to RCAT.
And it justifies that massive growth forecast.
This has been an incredibly focused critique. I think the goal here is just to maximize the professional impact of what is already a very strong piece of financial analysis.
Absolutely. We started by addressing the tone, shifting the focus from the sensational 646% magnitude to its significance as proof of a major production transition.
Then we dove into quantifying risk. We talked about integrating that huge $212.5 million cash reserve directly into the discussion, showing how it can absorb scaling challenges and budget delays.
And finally, we just talked about deepening that competitive moat, moving beyond the single Black Widow contract to show how the entire family of systems ecosystem creates a platform advantage that justifies that big FY 2026 revenue forecast.
The foundation you've built here with the verified Q3 growth and the contract visibility is really excellent.